want to thank Nick and Capital Link for hosting today. My name is Mike Weber, and I'm the Senior Shipping Analyst at Wells Fargo. And it's my pleasure to host the container panel this morning, which is also easily the sexiest panel of the day, clearly. You know, when I was coming up with my opening remarks, I was going to note that the container space is probably the most challenged sector that nobody's talking about, and then I realized that I was following the dry bulk space, so it actually looks a little bit better in retrospect. But I want to go ahead and do a couple introductions, and we're going to get started. I'll do some Q&A, and then we'll turn it over to the audience. But joining me today is Tassos Aslidis, CFO of NASDAQ-listed Euroseas, George Youroukos, CEO of Poseidon Containers, Dr. Van Meenen, CEO of Rickmers Holding, and Peter Shaerf, Deputy Chairman of Seaspan, which is the largest U.S.-listed container company. So to get things started, I want to start off with kind of the high level. That's good. Some high level questions, and if anyone who knows me and my group, we publish quite a bit, and because the container space has a pretty unique investor set, we end up publishing a separate container preview every quarter, and I went back and I looked, and it seems like the last 6 or 7 quarters, we've actually been pretty negative on the space, and most of that criticism kind of comes from demand levels. Some of that's been right, some of it's been wrong, actually, in terms of when you look at a company like Seaspan and the way they performed year to date, kind of bucking the trend when just about anything levered to China has traded off. But I wanted to start there. I wanted to start with demand, and specifically around containerized trade growth expectations. And I'm going to throw this out to everyone on the panel. But last year, we saw 2.3% containerized trade growth. That number has always kind of started at 5% in terms of most projections. It kind of worked its way down to 2.3%, which at least, as far as I can tell, is the first time since the financial crisis, and aside from that, the second time ever we've had a containerized trade growth number that's actually had a multiple to global GDP that's been below 1. So with that kind of context, I want to throw this out, and I'll throw it to everyone. Maybe I'll start with Tassos. In terms of what your expectations are for global containerized trade in 2015 and 2016, whether will be firmer on a year-on-year basis, and then specifically around that trade multiple, what sort of ancillary factors could propel containerized trade beyond just kind of normalized global GDP growth?
All right, thank you, Mike. I think it's a very difficult forecast to make. We see, looking around the world, we see many conflicting trends that it's very hard for us to come up with a specific number or expectation for next year, and I guess probably it's easier to do it for 17 because it's farther out and you don't need to be as accurate, let's say. But we see Europe being traditionally the biggest driver of demand because of the long distance to where goods are produced, and we see things in Europe that are pulling to different directions. I think the strength of euro makes more likely for products to be brought into Europe, but at the same time, the quantitative easing that European Central Bank is pursuing works the opposite direction. Plus, the turmoil with the refugees and the overall economies in Europe makes the picture there a bit confusing to us, frankly. So overall, and I can speak about the other regions, but just to give you a headline, I think we expect the trade to be just around or maybe even lower than what we saw last year. The multiplier, and we hope that to be a temporary development. There hasn't been 2 years in a row, if you look historically in containerized trade growth, that we had subpar trade growth. Mm-hmm. I'm afraid that we will see that in 2015 and 2016, and we look forward to see rates in trade growth in excess of 3% in 2017.
Fair enough. Peter?
Yeah, we're not dissimilar. We have a sort of fairly weak view that Europe stays a little weaker The States has picked up, and we think intra-Asia picks up a bit. We're sort of figuring around a 3%, 3 to 4%, probably in the lower range of that. How it manifests itself to the ships is obviously, a separate question. It can help the big ships, it can help the little ships, especially if it's intra-Asia, helps people like George and Tassos, especially.
Sure.
And you.
Dr. Van Meenen?
Yeah. So we think roughly around the same. Our base case is that the current growth is subpar, so it's a negative growth also for 2016. And again, I agree with Peter that the reflection of that in our container vessel growth, or the way we are looking at how we see time charter rates develop, that's a different discussion for a few minutes later. But our new normal is very, very difficult to see post 2016, because there are too many conflicting and too many different factors that play both from a macroeconomical point of view as well as from a technological point of view. Too many factors that have both a negative as well as a very difficult to assess longer term impact. We have the Russian embargo, we have the US elections going on, we have the TTIP not ready, we have the wars in the Middle East, we have a number of technological revolutions that we do not see yet what the actual impact on containerized trade will be. And all of that makes it the overall environment for the company as such difficult to position the company. So from that perspective, we are a little bit careful, and we're playing, as Robert says, we're playing defense right now, because I think this is not the time, especially in the containerized trade, to proactively go out and embark on huge growth from an investment perspective.
Mr. Youroukos?
Yes. I believe that to read the containerized growth, it's relatively easier than to read the dry bulk, because it's purely consumer confidence and consumer spending. We have to look at the global economy and see whether global economy is going into any recession, and we are interested in containers on developed countries, as that's where the boxes go. Boxes are produced in underdevelopment countries and shipped to developed countries. So we have to look at the United States and Europe mainly, and then we have also to look also at emerging markets where they have commodities as their main source of income, selling of commodities, producing commodities, which unfortunately hasn't been well for the last year, and that's one of the reasons why you have seen a reduction in containerized trade. Now, Europe has been doing better and better. It hasn't doing as good as the United States, obviously, but the European cargoes have dropped last year unexpectedly, whilst the 2014 have gone up 7.5%, which was again unexpected. So we have to ask ourselves why Europe reduced cargoes last year, and there are quite a few explanations, one being the sanctions, another being the strong euro, which meant that the Europeans were not selling that many goods and they were not being as strong buyers as they used to, and the commodities prices, which did not help. So if we think that commodity prices are going to recover slowly, then these countries who produce them are going to have more money to spend. Oil has played a negative role, as a lot of countries that were producing oil have lost part of their buying power again, and again, that has to do with container trade. But I believe that if we also look at what happened in 2009 and 2010, demand went sharp down, and when we see a sharp drop in demand, as people feel good when they do shopping, you can't keep population not spending and not buying for too long. And I think that once we see what we saw last year, a drop in containerized trade, and probably this year is going to be not that strong, maybe 3%, maybe 3.5%, that means that people have not been spending for 2 years now, and I think that it will probably rebound in 2017, same way we saw in a strong rebound in 2010-11 after the drop post Lehman Brothers crisis, where people were scared and not buying. purchasing managers did not stock the shops, and then they realized that there was more demand for goods that they, what they had, and then the market went quite strong on 2011.
Fair enough. And it seems like some of the container lines have the same line of thinking that you do around their, in terms of their order book, kind of keeping expectations going for firmer demands. And I want to stay there with you, George, around the order book. We're looking at 4 to 5% net fleet growth, I believe, through 2018. That 2018 number could probably come up a bit. I'm just curious, I'll start with you, then I also want to get Peter's take on this as well, around how concerned you are with that 4 to 5% annual fleet growth, considering the vast majority of it is going to be ultra-large container ships. So I want to get into the kind of the dynamics of that ordering process with Peter in a second. But George, with you specifically, how concerned are you about the order book for the next 3 years?
Yeah. I'm not concerned right now. I would have been a lot more concerned 2 years back because of cascading. I need to explain. These large ships only fit in one trade, Europe-Far East. 2 years back, that trade was being serviced by ships of 8 to 12,000, 13,000 capacity. Now, over the past 2 years, all these ships have been cascaded out, have been moved out of Europe Far East, and the big ships took over. As we speak, there are no longer more than 10 such smaller ships into the Europe Far East. So the net effect, even if we add another 300 of these large ships into the Europe Far East, is not going to affect the rest of the trades because there's only 10 ships that they can move out of these trades. What it really does, these very large ships, is kill the balance sheets of liner companies, which is a positive because the last 4 years after the KG collapse, the order book has been filled with liner company orders. And what we really need is liner companies to stop ordering. And I think that's where we are today. They realize that these large ships do not offer the economies of scale that they were hoping for, especially with the oil going down and demand going down. Because what's the point in having a 20,000 TEU ship filled with 12,000 boxes? It's more uneconomical than running a 14,000 TEU ship with 12,000 boxes, as you can imagine. So I think that the liner companies are coming to the realization that probably it was a mistake with respect to timing to order these large ships when the global economy has not been booming as it should to absorb that many number of ships. Obviously, that started with Maersk placing an order in 2011. Those were the first people to order these ships. I don't know if it was an accidental effect, but after Europe went into recession and the CEO was replaced, then everybody had to follow. Because once you have these large ships in a trade, the other liner companies have the option to either make the same mistake and follow or abandon the trade. That's the biggest trade there is. Therefore, it's not a question of being abandoned, and everybody had to follow the wrong timing, in my mind, of Maersk. So now we've got too many of those ships, and everybody has ordered them. There's no one else left. There are a couple of companies who haven't ordered them, but I don't think they will, seeing what's going on with their colleagues, and they can always buy slots. So there's an overcapacity of these ships in the Europe Far East. But that does not affect really our industry. It does affect, though, the freight rates of Europe Far East and the income of liner companies.
Fair enough. Yeah. Peter, Dr. Meenen.
Look, I think the biggest concern is not the order book that is, but if there is a rash of new ordering,
Right.
Which we don't see in the immediate term, there's a lot more rationalization, as George points out. The alliances are obviously working closer together. People can sort of, shift between different operators. There's a homogeneous nature to all of this. There was a rush to build the eco ships. I'm pleased at Seaspan we designed our Saver design, which became sort of state of the art and the flagship for a number of the liner companies in Asia. I'd be more worried if they started ordering a lot more of those in the next year than I am with what's out there now.
So along those lines, right, the contracting data would suggest they haven't placed an order in quite a while, I want to say October. But the rhetoric coming from CMA and Costco and others seems like there's still an appetite for larger tonnage. So you think most of that comes from existing on the water tonnage? Is it new builds? Dr. Van Meenen or Peter, either one of you?
No, I think it's like in everybody's watching a football game, and in one room, and one guy stands on his teeth, on his toes, and everybody else follows. So now they're all standing on their toes and having a little bit of difficulties in keeping up the balance. I think all of them, and we see it from a number of discussions we have with our clients, is they're all struggling to keep their balance sheet in order and managing for cash. The over-ordering of the larger vessels have in particular caused some anxiety and stress within those. The alliances of the liner companies are still open and in new discussions, in new formations. The Chinese take a lot of a proactive role in reshaping that landscape, and the effects of that, we will see that for not only for this year, but also for the next 3 years. So before everything comes back into a certain balance, and specifically from our side, as being not the operating owner, but more the swing supplier to the operating owner, that in particular gives us a somewhat more difficult position, because we will have to see and take a very focused look on how to place our bets, and with whom we will then, in what type of tonnage we would support those that are then viable enough to have a sustainable cash flow, and also cash flow towards the ships that we lease out to them.
Thoughts on anything yet?
On the size of the container ship, I think you start seeing more and more voices, articles, research, trying to make the point that there might be a limit on how big a container ship can grow. There was recently an article in Financial Times that was basically making that point, that the infrastructure, the seaborne and land-based sort of systems, probably for the time being have reached the limit of how big a ship makes sense economically to employ, and that hopefully is good news and sort of limits this domino-style ordering that was with us for the last 10, 15 years, and reduce the pressures in the industry. The effect of those big ships, which by the way now have the largest percentage of idle ships, is how that capacity will be cascaded down, if at all, to smaller sizes, and how that would interfere with the new Panama Canal and this type of thing. Interesting overall system to solve.
Fair enough. I want to move on quickly to financing, actually. And so just so everyone knows, it's not all bad in the space or challenging right now. There are kind of 2 points I want to make, and maybe we'll go to Peter on this first. One, I guess this is the 10th year of Capital Link, and this is the first year I can remember where it doesn't seem like there's a new wave of capital on the sidelines getting ready to come into the space. And for whatever reason, I think having come through the last couple cycles, there's always this kind of in the back of your mind, you're waiting for a kind of a crushing wave of supply. And it really seems like there might be some restrictions in that happening, at least for the next several years. So I guess, one, what impact has the lack of KG capital in the space had in terms of limiting third-party owners? And then maybe that's for Dr. Van Meenen and for Peter. The one bit of swing capital we've seen, at least on the debt side, has been Chinese. They seem to have a fair amount of liquidity available for certain owners. How big is that pool of capital? And do you think it's big enough to be on par or fill kind of what we're losing or going to lack from our European lending base? Let's start with Dr. Van Meenen on KGs and go to Peter.
Just on the KG, which is already a dead horse for many, many years now. Just for those who are not very familiar with the concept of the KG, it's basically the German MLP, single-purpose vehicle tax tonnage-driven structure where everybody could, as a single retail investor, invest in, supported and heavily subsidized by the German government. Main background from that is basically because in the northern part of Germany there was not that many production. and most of the wealth of Germany is concentrated in the south and in the western part. And over the last 3 decades, the result of that was, combined with the high leverage from the Landesbanken system backed by state guarantees, was an unbeatable WACC. The cost of capital was below 3.5% in total. And the result of that was basically more than 40% world market share in containerized shipping. Now, since 2009 gone, Lehman Brothers collapse was reverberating throughout the German industry, and the result of that is all of them dead and sitting on the back of their butt. Now, since that is gone, most of them, and Rickmers Group is not an exception to the rule, have to rethink and reorient themselves out of a very, very difficult situation, because the balance sheets were shattered, the liquidity was entirely gone, and the companies have not really figured out, or had not really figured out then, how to redesign themselves. And those companies, like Seaspan, Peter, you have been build up an educated investor base since many, many years. So the result of that, all of that was going more and more into that direction. And the German market had to think how, and scratch their heads how to get out of that. The alternatives today are basically more rational, more calculated, and more based on facts and numbers, investments that actually have a very higher and a more international bar in terms of how the returns on that investment need to be. The WACC is not 3.5. The WACC today is roughly around 8%. So with a WACC of 8%, your cost competitiveness is entirely gone. So in a way, that's a good thing, because then that tendency of oversupply coming from the German environment has entirely lost their steam and is now more driven by or in the last couple of years, driven by the liner companies themselves, some of those also by the Chinese leasing companies. And in the wake of that, some of the things that Rickmers Group have done was invite and team up with institutional investors from this community, but also from a few other communities, on the back of a strong, transparent governance. Some of that has been successful, but some of that is still not enough, because if the German community wants to maintain or start again in strengthening its position within this containerized leasing business, then these companies, and we're not an exception to the rule, we have to also strengthen the own equity positions within the markets in order to also use again the operational expertise that some of those companies have built up over the time.
Peter?
So, from a Seaspan perspective, we have certainly benefited from being a strong company, strong balance sheet, from having a strong Chinese base. I think, the Chinese capital is fickle. It has supported the bigger companies. I think there is more of it, but I will say that the constraints on it perhaps come from Chinese capital sort of supporting offshore and dry bulk and other investments that have not worked out quite so well. So I think that underlying an overall industry sort of depression is going to keep some constraints on Asian and Chinese capital particularly. I think at Seaspan, as I say, we're a strong company and we have benefited from it. And I think one will be cautious to say that it's going to be available for everybody. It's not available for everybody.
Fair enough. Peter, in thinking about Seaspan's access to capital, I think some of those loans are coming with 120% LTVs, which kind of gets you thinking about the residual value risk that's being transitioned to the lenders, and that kind of got me thinking about just the idea of deflation, right? And since I believe the beginning of the financial crisis, there have been 600 rate cuts globally, and most recently, even when we're seeing cuts or negative rates, you're seeing currencies appreciate, basically saying we don't care or we don't believe in you anymore. So I'm curious, as it pertains to an asset play, all right, and stepping into an asset down here that you could argue is at a cyclical floor, how much does how much do deflationary headwinds actually weigh on your expectations for return coming out of this crisis?
You mean on a residual value basis? You know, I think at Seaspan, you know, I'd speak for the chairman, Jerry Wang, when I say, you know, one of the strengths we have, we feel, as we designed and have pioneered these very modern ships. I mean, certainly they'd benefit a little more in a higher fuel environment, wouldn't we all? The residual values obviously haven't been tested. I don't think every 10,000 TEU ship is equal. I don't think every 9,000 TEU ship is equal. There are true design advantages to some. We've built, I think now 30 of our 10,000 Saver designs. We're comfortable with what we've built, that they'll hold their values. Obviously, you know, time will tell. We're not selling today, so.
Right.
And we've got long-term charters.
Right.
If deflation is the norm, then the whole framework of analyzing projects and thinking about life changes. If you know there will be persistent deflation, that has a very bad effect on your economic growth because it makes you defer your investments and your purchases, and you get into the downward spiral of reduced economic activity. So that's one very important effect, and I hope and I don't think we are on a sustained deflation path to be seen. If you talk about how you evaluate a project, assuming that the future dollars will be worth more than present dollars, that's an interesting exercise. I haven't run one yet,
Right.
but there are some technical aspects to it. It's very interesting to come to a point that we have to consider that.
Fair enough.
Michael, just one comment on what I like to what Peter just said is a very important point. From all the listed or unlisted container companies, the values have not, the residual values have not been tested yet, not to a big extent. And of course, we're all on long and focused on long time charter rates, but if you combine that and look at how the single SPV companies and the KG companies of the past have just focused on, this is my ship, this is a 10-year charter, and after 10 years, well, I hope I get my capital back. Now, in a very competitive environment that we all live in today, that is a big challenge. So on the back of that, if you rethink it, one of the logical consequences that you have to come to is actually that your single SPV company will be more heavily challenged than if you have like Seaspan or Rickmers or other larger groups. You have a number of vessels where you can pan out the volatility and the cyclicality of your cash flows. It's very difficult if you have a fleet of 10 ships and you have 10 of those are Panamaxes, and all of them are due for renewal on TCs in current today's market environment and come out of a $28,000 time charter environment on today's levels. It's a different story if you have 100 or 150 vessels and you have 5 Panamaxes due for renewal. Well, I would bet my future on having a more balanced and a more balanced risk assessment of my residual values, how you handle it, than if you do it only on a single SPV basis.
Fair enough. I've got time for one more question from me. I know there's a question in the audience somewhere around counterparty risk, so I'll let that come from the audience. But I do want to touch on corporate governance. Fiduciary duty and general corporate governance is obviously something that's very important to us, and I think it's something that's borne out in our ratings. So I'd like to go to each of you, and we can start with George. And I guess my question is simply, do you think corporate governance within the container ship space is up to par? And do you think there's a place in the current equity markets for related party transactions and fees? And we can go down the panel, but I want to start with George.
Yeah. The first thing that I learned about dealing with U.S. investors is alignment of interest. There has to be no conflicts of interest in any shape or form if you want to be successful in the U.S. Container ships are the hardest type of ship to operate and the hardest type of ship to manage because of their schedules and their size and their engines. They have like 5 times the size of the engine and 5 times the size of the technical equipment on board than any other type of ship. So looking at the public companies' management fees and looking at the private companies that I know of management fees, they're very comparable, if not lower, to other types of ships, which makes them, I think, very correct and very honest. So I don't think in our industry we have the anomalies that we see in other individual examples where companies exist just to feed, with fees, management fees, the managers and not really align interests with investors.
Okay, so related party fees are fine as long as they're,
Yes, yes. As long as, for example, the two large public companies, Seaspan and Costamare, I think they have very correct fees, which is public information I can know.
sure. Okay,
Yeah, for me, exactly same. Yes on corporate governance, on full transparency. Also, yes on disclosure of everything that is related party, but also yes on try to minimize the related party issues within a company. Based on all the discussions I've had in the past couple of years with institutional investors, is the more you align those and the more you put them in the same company where you ask people to invest, the better you will be able to grow your company. And last but not least, also an alignment of interest between management and the shareholders as well.
Yeah. It's hard to argue with any of that. I think we actually, at Seaspan, George, we took in our management company. We bought them out about 3 years ago. And it is all about transparency. We actually have a conflicts committee, which I chair at Seaspan, which is in addition to the governance committee. So we're really on top of it. It is totally alignment of interest, preservation of value for shareholders, and full transparency. I think that would be unanimous across this table.
That's indeed true. Alignment of interest, transparency, and continuous benchmarking is what you need to do to prove to the investment world that everything is done properly and you're fulfilling your fiduciary obligations.
Okay. Take one from the audience, real quick. Back corner there.
Yes. Could you address counterparty risk and more specifically the ongoing negotiations with HMM and the implications for the container world?
Anyone want to swing at that?
We have no ships with HMM, I can't.
Just counterparty risk in general, right? I mean, if we see mid-tier lines starting to buckle, one or two hitting the wall, what kind of conversations are you having with your counterparties right now? And is there a scenario where we see more lines actually come back to renegotiate contracts?
Yeah, we have a few, to be specific. And of course, that is an issue that we very much focus on in how you deal with that and how you then actually react, not only from your company perspective, but also from within the community of other non-operating owners who have chartered out to a specific counterparty. We all had, some had experience with the Zim case a few years ago, and something like that comes along the same line. So what everybody tries to avoid is that you give in too much. What everybody tries to avoid is also by tipping over one of those some of those that we deem viable, that they drop off the cliff. But of course, before you consent to anything, you need to be sure that the concept of a shipping counterparty risk or an operating liner company is viable enough that it gives you a party that is also deemable for the future.
May I add something to that? Container shipping is completely different. I think the counterparty risk is different fundamentally from the rest of the shipping sectors, because the charterers are not commodity traders. In wet and in dry, the charterers are commodity traders. They're making money from selling the commodity, and they just use the ships to move that commodity. In containers, it's like a FedEx. They don't own the cargo. They have nothing to do with the cargo, and therefore they take far less risk, because their only risk is whether they charter a ship or they build a ship. that's why historically we have seen very, very few counterparty risk failures. There was one with ZIM, and now this is with HMM, very far and away. And neither ZIM or HMM was on the top 10 lead table. I don't think that the top 10 charters or top 12 charters are in any danger going forward, or have been over the past years. So which we see in dry bulk. I mean, you see in dry bulk even the best of charterers renegotiating and cancelling. So containers does not have that much of a counterparty risk than the rest.
Fair enough. Any more comments? Last chance to disavow related party fees? Anybody?
We're good with that.
Okay. All right. Thank you very much, guys.
For us, it's a tremendous gathering of investors and shipping professionals. I walked in at 8 o'clock this morning and the room is absolutely jam-packed. It's tough to get people up for anywhere in New York on a Monday morning, but Nick seems to be able to do it, so that's pretty impressive. But consistently, and I've always told him, having the conference on the Monday has been a great day. It's filled, it's interesting people, and it's a great gathering. It's a tremendous conference, and it's a staple on the New York calendar, so we're very happy to be here and to help sort of represent the container industry and be part of it. I think the panels are nice and effective because it's not just focused on the company. We can talk about the industry and to somewhat as it pertains to our companies, but it's not that constant sales pitch that you hear at investment banking conferences. So the panels are a very helpful sort of forum for industry discussion. My message was to get across that Seaspan is the leading provider of container ships, that we have a diverse fleet and we have access to capital. This is a great place to tell the story.